There have been umpteen reversals of that percent dimension over the last 3, 4, 5, 6 months. They come, they go. It used to be when silver had those kind of breaks, like back in March through April of 2025, it had a sharp drop from 35 bucks down under 20, no, under 30, excuse me. So it had a pretty big drop percent-wise, okay. And then it came back up again and blew through in the summer, blew through that dual price highs at 35. But that had been a whole year of constant distribution of silver. But the doubters kept, nah, it's topping, it's topping. They kept selling, and yeah, it kept going down, but it kept coming back up. That's not the way silver tops, by the way. But now each time you get one of these events, they tend to be briefer in time. Sometimes they're 2-3 weeks, like in October. Then suddenly they're 2 or 3 days, like we had about 3 weeks ago. Had a double-digit percent drop then. You used the word, I think, unusual or something, and that's dead right. That's the word. Don't expect the normal. Yeah, bull markets come and go. They get overdone. They correct. And so this is a move by silver into a new reality. That's the best way I can phrase it. We've used that for about 6 months now. The old reality was a half a century price range. $4 to 50, $4 to, yeah, etc. Just caught in this range. And frankly, while gold in that same period of time would take out its prior high by many multiples. Well, silver was still contained in a little box. Like, we don't need silver anymore. Well, they find out they do. Okay. They needed an AI. They needed, all this stuff. Solar panels, the whole thing. So there's a new reality there fundamentally in terms of the industrial demand versus the supply deficit. Okay, but it's still money. People forget that. They don't consider it the same as gold. Well, humankind has, for 3,000 years. And right now it is very cheap. Ounce of silver, respect to an ounce of gold, it's like 2% right now. Early this year, silver was like 1% of the price of gold. So it's had a huge move. When you go from 1 to 2, that's a doubling. Okay. So it's definitely caught up, but it's old reality when you measure that ounce of silver versus the mama metal, the monetary metal. Back in the 79 to 80 bull market when silver, again, in that box, $50 peak, ran up to 50 bucks and it was 6.5% of the price of gold. In fact, it stayed up there a while too. For a couple of years, it was in that 6 zone. Okay. Then in the 2011 bull market, when we went from like 10, 15 bucks up to 50, took a couple of years, a lot of it in the last couple quarters of that move, just like in 79, 80. Silver reached a relative peak to gold of 3.1%. Okay, so even right now at 2.1%, we're still cheap. So if price broke out of its confinement range of a half century, consider the possibility that silver could reassert itself as that baby monetary metal and get maybe back up to the highs it saw in the last 50 years, which say 6+%, 3+%. Wow. I mean, and consider also the fact that it's not going to do that with gold going down and silver going up. They're both going to be going up. Silver's going to be going up more. So good grief. I mean, if silver were 3% of even current gold, you'd be like 150 bucks. But if gold goes on up, I've speculated on this before. It's just a truth. It's not a projection, actually. The 2 prior bull markets in gold were 8-fold dimension. From bear low to bull high, bear low to bull high. If you measured the dimension, the logarithmic scale, it was an 8-fold gain. Well, heck, if we do an 8-fold, gold's going to be $8,500. And if silver's 3% of that, ooh boy. Or what about if it's 6% of that? You get my point. Okay. This game is only beginning. So everybody thinks, oh my God, I gotta take the profits. And I understand. Because if you've been in silver for even just the last 3, 4, 6 months or so, you're making so much money so quickly that you can't believe it. And you think, I got to grab my money and run. And what we're arguing is, this is not normal. Don't treat it as a normal. We shall see, but there's a lot of reasons for that, one of which I just explained. This time around, if you measured, for example, gold and divided the price of gold per ounce into the S&P price, you go back to that bear market that peaked in 2011 and collapsed through 2015. Okay, price went down, but also the performance of gold relative to the S&P was in collapse mode. Okay, we've run that chart many times, and back in November, when you plot that chart, 11-year wide base, where if you looked at that spread chart, you'd just see this big drop and then 11 years of this up and down action, where there were times gold would beat S&P, then come back down and beat it, but basically sideways. You broke out of that range several months ago, where gold said, I'm coming out of here. Okay. Silver at the same time did the same thing versus the S&P. The gold miners divided into the S&P did the same thing. So they all had this basing chart pattern, relative performance chart, and they all broke out in unison. Well, not just in terms of relative performance since then. Look at the net price gains you've seen since November. Gold, silver, GDX, XAU index. This is a vertical, okay. But that just began. That's only a couple months old, that buy signal, that relative asset class shift, okay. The fear of a lot of the mining investors is that it's based on a few isolated incidences in the past that aren't indicative of the prevailing trend relationship between the, like I said, the gold and silver miners versus the S&P. But they remember that collapse in 2008 when the S&P had been coming down for a whole year. It peaked in 2011, October. But in October 2008, the S&P finally puked in what you could call a crash event. At that point in time, gold, silver said, I'll correct too, in an ongoing uptrend. And the miners got clobbered. But when you study the relative performance back then of the miners versus S&P, there was a floor on that relative performance chart, the opposite of what we've had recently, a floor that we broke out of, a ceiling we broke out of. Back then, it was a floor that any idiot could draw a line through. And you collapsed through it in September of 2008 so that when that October event occurred, where, oh my God, the miners are collapsing too, the spread already warned you that that could happen. This time it's the total opposite relative measurement of miners, gold and silver miners versus the S&P. They just broke out upside versus a pattern of performance versus the S&P. So it's technically totally different this time. And also, I don't think our analysis of the stock market that we're going to have a precipitous crash-like event anytime, let's say, in the first half of the year. It could happen later, but we don't see the technicals for that type of event. A downturn, yes, perhaps double-digit even. But remember, we had a double-digit drop between January and April, 20%, S&P. What happened to the gold during that time? Well, that doesn't help in the past, because when the Fed starts cutting aggressively, it's because they know something's bad going on. And admittedly, he's going to be out of there in May, Powell, regardless of what happens between now and he's out of there in May anyway. And so Trump, our quote, free market president, is now a primary advocate of print. Okay. And he's going to make sure that who's ever in there is going to do that. And so, the free money is going to flow. Okay. Again. But the question is, what benefits most when they really put the pedal to the floor at the Fed? Always, it's gold. It loves lots of free money because it's real money measured against collapsing real value of fiat currencies. So, if they do that, that benefits gold. So cheer it on, cut those rates. Big moves in the dollar, for example, if you go back to December 2015 when gold made its low at 1,050, the dollar index was around 97, 98. After that time, you could draw a line sideways for 10 years through 2025, up and down action either side of that price level in the dollar index. Meanwhile, gold doubled and tripled during that time. So the dollar didn't really impact gold over the last 10 years of gold advance. Okay. But right now, in March of last year, the close on the dollar index was 104.21. We said, it's over, it's going down. That was a major bear signal because we broke momentum, long-term momentum uptrends, not price. The price drop that followed took us from that 104 down into the 96, 97, 98, 99 zone, and we've lived there for like 9 months doing this. In other words, nice little rallies, but they don't go anywhere, and then right back down. And right now we've traded below 97 again, like today, I think. You close the month out around 97 or lower, which is in the bottom sort of end of that recent range. There's an uptrend on the price chart. That's what everybody looks at, right? The price chart, the monthly bar chart of the dollar index. Going back to 2010, you can draw the uptrend line. You've been dancing on it for 9 months. So in other words, the reason it stopped going down is the price guys were buying this trend line, even though momentum's already broken the comparable trend line. Momentum usually wins, okay? If you close about 97 this month, and you've been there today, so 3 more days, 3.5 days left in the month, assume that the price is now going to start to move down in a way that people notice. And so the dollar, you're right, is suddenly going to become a noisy thing and create some, side effects. And one of them, obviously, will help. It's just further fuel for gold. There have been umpteen reversals of that percent dimension over the last 3, 4, 5, 6 months. They come, they go. It used to be when silver had those kind of breaks, like back in March through April of 2025, it had a sharp drop from $35 down under 20, no, under 30, excuse me. So it had a pretty big drop percent-wise, okay. And then it came back up again and blew through in the summer, blew through that dual price highs at 35. But that had been a whole year of constant distribution of silver. But the doubters kept, it's topping. They kept selling, and yeah, it kept going down, but it kept coming back up. That's not the way silver tops, by the way. But now, each time you get one of these events, they tend to be briefer in time. Sometimes they're 2-3 weeks, like in October. Then suddenly they're 2 or 3 days, like we had about 3 weeks ago. Had a double-digit percent drop then. And then they're 1 to 2 days. And now today it's intraday. Ignore them. Silver is going to a new reality. It's going to do, and we've shown studies on this that have happened in other markets. They're rare events. When a market is confined in a price zone for too long, like multiple decades, not reflective of the ongoing collapse and decay in the real buying power of the dollar. So not reflecting the real death of the dollar, not the dollar versus other currencies, but just the dollar in terms of its real value. They break out. Copper did this in 2005, late 2005 through mid-2006. It quadrupled in a couple quarters. It lived in a range from 50 cents to $1.50 for like 30, 40 years. And when it broke out, in literally a couple quarters, it quadrupled in price. No specific event for copper caused that. And it wasn't common to all the base metals. It was just copper. Okay. Then lead did the exact same thing in 2007, where it had been in a range for like 30, 40 years. Finally said, I'm out of here. And it quadrupled in a couple quarters. And then after that lived in a new reality, quadrupled the price basically of what had been the old reality. Well, silver, why was silver confined in a 50-year range? Well, gold wasn't, copper wasn't, lead wasn't. Well, there's some arguments as to why. Okay, I won't get into those. But once it gets out of that range, it's saying, I'm PO'd. I've been kept back. I'm not in reality. I'm going to a new reality that reflects the ongoing decay in the money unit. My relationship to gold has been too cheap too long, et cetera, et cetera. And it's having a tantrum. Expect that tantrum to be mostly occurred in a couple quarters. A couple quarters measured by what? We measure the spread relationship between silver and gold. That broke out of a massive basing pattern. And when that happened in 79 and happened in 2010, that's when you went berserk in both of those bull markets, where like silver tripled, quadrupled in a matter of a handful of months. We just broke out in November. So we're like a month and 3 quarters into what is the unleashing. Don't be surprised that it lasts. I'm betting, I'm not betting, I'm analyzing, probably into summer, June or July. There will be a jiggle in the middle. And I don't mean what we saw today or these a jiggle that really, you can see it on a monthly chart, for example, not just a daily. I don't think we're there. I strongly suspect that that jiggle won't even occur until we get into like later in this coming month or March, and probably at much higher levels than we saw today. But even that jiggle is not the top.